folks, and welcome to another video. Today I'm talking about the distinction between repairs and maintenance and capital expenditure in relation to a building. Firstly, why is this even important? Well, the stakes are high from a tax point of view, and here's why. Repairs and maintenance are typically tax deductible, which means $1 spent will typically save you 33 cents in tax. In the old days, capital expenditure was tax deductible over time. By that I mean it was added to the cost of the building, which could be depreciated for tax purposes at 3 or 4% or whatever the rate was back then. But these days one cannot claim depreciation as a tax deduction on a building. So what? So there's a 33% tax deduction available for repairs and maintenance, but no tax deduction at all for capital expenditure. So when you spend money on your building, how do you know whether it's tax deductible repairs and maintenance or capital expenditure, which will fall into a big black hole? Sometimes the answer is not so black and white. For example, consider Jack and Sophie, both owners of buildings with dubious roofs. They're both up for a bill of $15,000 to replace and make good their roofs, and they both rather like the idea of the $5,000 tax relief should the expenditure be tax deductible. In Jack's case, he's recently purchased his building with the roof well past its use-by date. The $15,000 he just spent replacing the roof was capital in nature and not able to be deducted for tax purposes. The price Jack paid should have reflected the fact that the roof would soon need replacing. Really, the cost of the new roof on Jack's building is just part of the cost of purchasing the building and bringing it up to a state where it will be serviceable for the years to come. No tax deduction. Sorry Jack, sad but true. But Sophie has owned her building for a dozen years, although in the past couple of years it has become clear that the roof will need replacing. Sophie bites the bullet and spends the $15,000 to bring the roof back up to a standard it was when she first purchased. This is likely to be fully tax deductible repairs and maintenance, meaning most likely a reduction in Sophie's tax bill of $5,000. So the answer to the question, is this tax deductible, is likely to be, it depends. If you're simply bringing your asset back to the condition it was in when you purchased it, there's probably a good argument for a full tax deduction. But if you're improving your asset beyond its original condition, then like Jack, most likely no tax deduction. As always, because every situation has its own unique twist, give me a call before relying on these comments. Thanks for listening, and please hit the subscribe button below for more updates.